Today, a UK-listed microcap semiconductor company, and this is a very hot area at the moment with data, AI, etc. Anyway, this company released their final results for the year. Their revenue grew by 22%. They are profitable, have cash of over 20 million, no debt, and pay a dividend. They're also expanding in the US and have a fair chunk of property they could sell, which could boost their cash reserves further. So, let's put them through the spreadsheet and see how their metrics stack up. That company is CML Microsystems, ticker there, CML. So what do they do? As a quick overview, they're listed on the AIM market of London, headquartered in the UK, and operating with a global presence. CML develops mixed signal, RF, and microwave semiconductors for global communications markets. Okay, very fast growing area. Established in 1968, 7 offices, 130 employees worldwide. And if you scroll down, they say the strategy in today's connected world, there's a need to transmit and receive ever greater amounts of data more quickly and reliably. We engage with our suppliers, customers, and partners to fulfill this need. Their strategy is to deliver technologically innovative, market-leading solutions through timely and effective market research and engineering development, focusing our resources effectively to enhance our customer relationships. And they say we seek to expand our total addressable market through existing customer proliferation and new customer adoption in current and adjacent markets. So we are. That's the website there. Okay, and let's just go back to have a look at a bit of news here. So these are the highlights from their financial and operational results for the year ended the 31st of March. So revenues 22% up to 20 million. Profit before tax 5.2. Cash balance at the end of the period 22.26 million. Significant share buyback and a recommended dividend. There's a lot of good news there. Operational revenue growth broad-based with resilient end markets. 7 new products released. 25% of revenues invested in R&D. Initial disposal of excess land following grant of planning permission at Oval Park. They got about 2.5 million for that. Like I said, there's more of that going on. They say following this transaction, circa 15 acres remain available for disposal. And additionally, the group has commercial property in Fareham, Hampshire, that is access to operational needs. So there's possibility more cash coming from that. And the outlook, they say, as a business, we are confident that the strategy we are following is going to yield the sustainable long-term growth we are looking to achieve, and these results are a clear endorsement of this. We have exciting opportunities ahead of us, an expanding product line, and a robust ongoing R&D program. In addition to this, we have planned assimilation of MWT into the group. This is the company they just acquired, and they're looking to get US approval on that, with expected benefits from the combined business helping to expand expertise, increase operational efficiencies, and scale alongside the market. Okay, let's put them through the spreadsheet and analyze the results. So here's the spreadsheet, of course. This side is 6 months interim results to 30th of September, and this is the most current set of results now, the full year results to 31st of March. Share price, 4.59 pence, market cap 71 million, enterprise value 48 million. So of course the enterprise value is below the market cap, there's more cash than debt there. Net asset value 50 million, so above the enterprise value, is very good. Average daily volume is around 81,000, so it's not a huge amount of liquidity there. A tenth that, of course, is 8.1 thousand pounds. Revenue 20 million. Operating profit 4.9 or 5 million. Cash 22. No debt. Always very good. Big chunk of cash. No debt, which is good, of course. They need to acquire other businesses. Operating cash flow 5.4. Free cash flow 7.4. These are very good metrics. Dividend yield of 1.3. Still a growing company, but plenty of dividend cover. So I'll put them through growth, value, health, efficiency, and momentum, and then forecasts. Okay, growth-wise, all green. Top marks. Doesn't get better than that. For a growth company, you want growth. You need growth. Value. PE is good. 15 there. It's improved from the half-year results. Price to book 1.4. EBITDA 6. That's what it is. Price to free cash flow 10. All good pretty much. No point looking at the price of sales there. Health. Very healthy company as well. I mean, you very rarely see the quick ratio like that. So that's an excellent. So they've got growth, they've got value, they've got health. It's all looking very good. Efficiency, gross margins up to 75%, operating margins there 24. I mean, return on capital, it's a little bit low. It's not too bad though. And let's go to momentum. Now, there's a little bit of an issue with momentum. Let's have a check. Let's check out the chart here. Now, this is going back. It's done very well. Let's be honest. I mean, since September in 2022, it comes from 340 up to 580, but it's come off a bit recently. As you see, it's broken the 50-day moving average, and now we're having a bit of a golden cross, but there may be some support here. As you can see, this level here pretty much is the previous peak back in August 25, which is around about 438. So you can see there may be some support here in the RSI on today's news. It's always good to see a share price rise on final results. In my mind, the final results are warts and all. They give the most detailed report you can get in a company. So when they put that out to the market and it rises by 4.74% up today, then that's good news. So we may have seen a stop in the downtrend, and we may be reverting to an uptrend here. Of course, that can take a while, a month, 3 months, but nevertheless, the downtrend may have ended. So, if we go back to the spreadsheet, of course, the momentum based on the moving averages and the crossovers, this could change. All right. What's not as strong is forecasts. And I've got no sort of broker forecast out there, but I've based this on growth they've had recently, and this in fact they've got one broker target out there for this. But of course, if they continue to grow at 20%, then this will be a lot higher. Having said that, the returns are decent, So let's go to the scores first. If you look at the scores for this is finals and interims, 100% on growth, 70% on value, health 100%. Total efficiency, 80%. Momentum, that can change with the share price, of course, at 44 and forecast 55. But of course, that can change as well, especially if they've assimilated this new company into their business. That could uptick. But nevertheless, so if you look at the returns here, based on revenue growth of 12, 12, 12, which is below what they did last year, so it's quite conservative. Margins of EBITDA 37, 25, 23, which is what they're at, and multiples of 3 on the sales, 10 EBITDA, 20 post-tax. Then you get 23% this year, up 38% then, 24, and a target price for 2025 is £7, and we're at 4.55 now, which is 55% up. But of course, that could change with this new business being assimilated into the company, and forecasts may go up. But that's based on just 1 year sort of forecast going forward. I'd need further transparency, visibility on those forecasts. But I think this is a very healthy company. And like I say, if you look at that, it's pretty much all green, score above 66, and so it's in the top third of companies I've looked at so far. So for me, CML Microsystems, it's a thumbs up.